Capitec's trading update sent its stock 2% weaker. The deposit-taking micro-lender says first half headline earnings per share could rise by between 25 and 35%. Now, the growth numbers certainly aren't bad, but they have been losing steam. The share price closed down over 2%, as I said, to 224 Rand rather. Patrice Rassou, Senior Portfolio Manager at Sanlam Investment Management. He joins us on the line from Cape Town. Hi, Patrice.
Hello, how are you?
Well, thanks. Is that share price decline justified? Is it market, given that it's trading at a PE of around 20 times, that you need to do a great deal to justify these elevated levels, Patrice?
I guess in the case of Capitec, it's definitely the typical growth share where the market has gotten accustomed to very high growth rates. And when we saw the guidance of 25 to 35%, you must compare that to what consensus was expecting, which was over 40% for the year. That's where the disappointment comes from. The other thing is you have to bear in mind that it's still a company which is growing its loan book very aggressively. Last year that was in the region of 70%, but this year the run rate is around the 50% mark. So it's still growing very aggressively, and maybe the expectations in terms of what that translates into profit was a tad disappointing, and unfortunately this is what you get with shares which are almost priced to perfection. When results come out slightly below market expectations, you get a bit of a sell-off, which is not that dramatic, given that the share's done quite well and over the last few weeks going from closer to 200 Rand towards the 225 Rand levels.
Patrice, I mean, this is such an old story. Everyone's trotted this one out. Is there a bubble in this unsecured credit? I mean, we had Georgia earlier on saying that it's really the only game in town. This unsecured credit is a large part of the credit creation, and credit creation is the only thing that's keeping consumption going here. Is this something, I mean, it would be a very normal cycle, but is this something that worries you specifically? Because when any cycle comes to an end, there's always fallout.
Yeah, it's a very good question. I think we've seen in the front page of the newspapers, the regulators are quite worried about it. But as you know yourself, the thing with the bubble is that you don't realize you're in it until it bursts. So hopefully in this case, many people, including you here, are asking the questions early enough and questioning what's going on. I guess we've seen before that very strong loan growth, if it's not done with the right credit scoring model, tends to end up in tears. And in this case, I think what's been very worrying is that something which was a very niche part of the market, where you had specialists involved in it, has become very widespread, as you mentioned, and now you have everyone, including the sort of front line, the big four retail banks involved in it, and it goes beyond that in terms of the furniture lenders, even the clothing retailers. And this seems to be that the use of these loans has gone broader from maybe borrowing for house improvements to consumption, which would explain the very strong retail sales.
Patrice, you referred to the regulators, Minister Gordhan being quoted as saying the onus is on the banks to be lending responsibly. But as we know, unsecured debt about 5 to 10% of their books. So still a fairly small portion, as you say. With the retailers, it might be bigger. I must say, I was quite surprised walking through a retailer the other day, those that so easily provide you with credit, warning against the risks of being indebted. So some mixed messages that we're getting.
Yeah, I think the regulators are doing the right thing. There is quite a lot of moral suasion going on, in the sense of the regulators are being quite proactive to try to ensure that the type of lending that we think is not out of control. I mean, we've seen that before, I mean, in terms of the Unifer and Sambo crisis. So it's not as if we haven't seen problems that result from lending which is out of control. In this case, there is a context to what's going on, in the sense of secured loans, like home loans, are very hard to go by because banks have tightened on their criteria. Maybe it's because of Basel capital regulations, but unsecured lending has become an alternative to sort of more traditional sources of secured lending, which is something which might stay with us for the longer term as banks try to conserve capital.